welcome to the BPF Futures Policy Congress on the emerging trends in residential real estate. My name is Madeline Rogers. I am in the asset management team at Legal & General Investment Management, focusing on build to rent mainly, but the residential sector. And in this capacity, I am a board member of the BPF Futures, alongside my colleague Gafar.
Good afternoon, everybody. Welcome. My name is Gafar, as Maddie said, and I work at Related Argent on the development team over at KGX1, and I'm also a board member for influencing for the BPF Futures. So welcome to this event and this session.
Brilliant. And I think you might have seen in the invite for this session and the marketing around it, what we're trying to talk about today is that residential real estate is an emerging asset class. It's relatively new, but it's institutionalizing and professionalizing all the time. Yet at the same time, there's a supply and affordability crisis, which we're hearing about lots and lots in the news. We're both participants in the housing market, because we live in around and in rental housing and buying houses and things like that, but we're also obviously real estate professionals. So with both those hats on, we're trying to gather today what's next in the residential real estate sector, what are the issues, but what can we collectively as well try and do about it, or any ideas to start to improve the sector. I'm just going to run through briefly who the BPF is. Who BPF Futures are. I'm sure you will be quite well aware, given that we're on a BPF Futures event, but just to recap, the British Property Federation really represents the UK real estate sector. So it has members from all over the sector, all the different sectors in terms of residential or commercial or offices, retail, everything, and whether you're an investor or a funder, developer, agent, lawyer, loads and loads of different jobs and different professions represented by the British Property Federation. And one of the main ways that BPF engages with the members is with committee meetings. So around 20 committees, and they meet quarterly, and they really share best practice information on what they're working on, but also contribute their perspectives to help respond to government consultations on upcoming legislation and what's going on in the industries, to provide that collective voice for the industry as opposed to individuals, which might not make such of an impact. On to BPF Futures then. BPF Futures is more of the junior professional side of BPF. It's free to join, there's no age limit, but all it is you have to have less than 10 years industry experience. You also don't have to belong to a firm that is a BPF member, so do tell your friends and come and join in on all the events. We've reached about 2,000 members now, which has really grown massively, so it's great to see lots of you here today as well. And BPF Futures is run by the advisory board. So it's chaired by Isabel Heath. And then there are a big number of, or a few other different board members with different pillars, which I'll go into on the next slide. But we also have really strong representation in Scotland, and also a seat for the regions as well. Not that we were ever just London focused, but we just wanted to make sure that we were really representing views and making sure we were going out to various different, getting various different events out and about as well. On the next slide just shows the 4 pillars that the BPF Futures Board works on. So that's influencing, as Gafar and I are the members for influencing. There's learning, mentoring, and networking. And you may well have got involved in a huge number of events that are going on. So we've done 16 events just this year. We've done some site visits with Birmingham, Glasgow, London, some great networking events as well, as you can see one of the pictures on the screens there, online events too. And also I'm getting involved in the wider BPF conferences. On to today's session after that whistle-stop tour. As I was kind of mentioning as people were joining, we're going to be running some polls and some questions on Slido today. I'm sure you will have used it, especially from the lockdown days before, but all you have to do is go on slido.com. If you type in Futures 23, I think that's with a capital F, As our various different speakers are running through their sections, there will be different questions that are popping up. We'd really, really appreciate your views and your responses to those questions. It is completely anonymous, I think, unless you put in your name, but it's completely anonymous. And what we're looking to do is really gather your opinions, and then we'll look to share the results after the event. So share it with the people that have been involved, share it with the wider BPF Futures network, but also seeing if we can feed in some of your views to what BPF are doing and the influencing and responding that they're doing to government policies, and Ian will talk more about that as we go through the session. Quick agenda for the session over the next hour. I'm going to run you through an emerging trend in residential real estate, and that's of BTR. So I'll take you through a little case study. We've then got Jessica Tomlinson from Savills, who will do an update on the residential market at the moment. Ian Fletcher from BPF will talk us through what's going on at the BPF at the moment, what the BPF do, and how they come together to influence some of the policies and what's going on in the industry at the moment. Jess Cunningham from Legal and General Investment Management will then come on to speak about the investor's view of the residential real estate market and how some of that investor money can help try and work with some of the challenges that we will be speaking about throughout today's session. We've spoken about Slido, so again, do get yourself on there. But if I can ask that if you have any questions, please put them in the Q&A of the Zoom webinar rather than the Slido link, just so that they're all in the same place. And we will hopefully get through everything we wanted to get through and talk to you about today, and then get onto your Q&As at the end for all panelists. So hopefully we'll have enough time and we will get there. So that's all the housekeeping bits to do. I will then start on the emerging trend of this of a case study. It might seem a bit simple, but I wanted to touch on just what is build to rent as a case study. And obviously build to rent is properties that have been built specifically to rent, as opposed to the kind of wider rest of the sector that may have been conversions or flats or houses that were built for sale that are now being rented out by lots of different private landlords that are managed in lots of different ways, varying qualities, varying different customer service. So BTR is kind of the opposite of that. It's still relatively small, still a relatively kind of emerging sector in the grand scheme of things. So over the last 10-ish years, it's called multifamily in the US, and that's been going for 20, 30, 40 years. On this slide then, you can see it is a CGI at the moment, but of one of Legal and General Investment Management's build-to-rent fund assets in Wandsworth in southwest London, and it's called New Acres. So you can see that it's a pretty big scheme over quite a few blocks. It's a £500 million investment for the build-to-rent fund, and that's mainly other pension fund capital that is coming into that. You can see that it's a little bit of a constrained site. In one way, it's fantastic because on the, sorry, Gafar, just go back one slide. You can see that there's the railway station just at the bottom of that picture there. So it's really close to the railway station, so great connections. It's obviously really close to the river as well. And some of the apartments on the top floors of the blocks have fantastic views across the river and into the city. You do have that road running through it. On one side of the road was a B&Q at one point, and on the other side was a home base. So it's kind of, and with big car parks. So it's really looking to intensify that land and put it to a slightly more useful land use, and in terms of what's going on in the residential market at the moment. On to the next slide, which kind of just runs you through a bit of a high-level overview of what's going to be on the site. So there's 1,000 odd apartments, so studios, 1s, 2s, and 3 beds. A good chunk of those, 350, are affordable homes, so different tenures, whether that's shared ownership. We've got affordable units there. We've got discount market rents too. There's a huge amount of resident amenity space, whether that's co-working space, private dining rooms, a gym. There's a concierge. There's your parcel room, so you're never kind of going to miss a parcel. It's a really kind of convenient living. There's also a outdoor swimming pool, resident Slido there too. There's not a lot of car parking spaces, but there are quite a few cycle spaces, and that's really to try and push residents to continue to live sustainably, and that's something that's really important to us and really important to the fund and our investors in general. On that next slide then here, you can just see a few CGIs. It completes in the first block completes next month, and then it's about a 12-month program after that. So we've only got CGIs, unfortunately, at the moment, but soon we will have real photos to share with you. But the top left-hand photo is the main entrance. You can see on the larger photo that there's quite a lot of green space with podium gardens. I think there's about 250 trees being planted around the whole site. The bottom left-hand CGI just shows one of the big avenues that goes through the scheme. There are around 22 commercial units across the whole scheme, and there's a big strategy for who we're going to put into those commercial units. We're not just going to pick the business that's going to pay us the most amount of money. We really want to curate that space and put in things that are really useful to the resident, but also really useful to the wider community, and uses that are going to really enliven the space and draw people in. The next slide is some real photos of some of the other build-to-rent schemes that we have in the portfolio, one of which I'm sat in actually today. And we just wanted to show here that they're really carefully considered design, really high quality homes. We want to make something that people are proud of, that they really want to call their home, that they want to stay for a long time. Something else I touched on a little bit earlier is that they're professionally managed. There are on-site teams, whether that's your maintenance team, your resident services team, that are organising events for everyone to get to know each other and build that community. There's also the security of tenure. We plan to hold these assets, these buildings, in the fund for a very long time. There's no one, we're not selling them at any one point, so you have that security of tenure. You can sign up to a lease that's 5 years long. You know what your rent reviews, there's set rent reviews within that, so you know what that's going to be. You can decorate your flat, you can have pets. So it's really kind of that opposite of what some people may have experienced in the wider rental market at the moment. And it's all about being a responsible landlord and making sure that our residents are happy, that they're safe and well looked after, and really enjoying the homes and the communities that they're living in. The next slide is the last one on the case study, but it was just highlighting that something that's really important to the success of this scheme for both our investors but also our residents is the placemaking element of it. We really need to make sure that it's somewhere that works for the rest of the community in terms of what's outside and around our scheme and our location. We're creating a new neighbourhood effectively. There could be 3,000 people living there. We need to embed it to the wider community. We need the commercial units to thrive. So we need people to know there's a new area here and that it's something really exciting that they need to come and check out. So it might be whether we put a flower market on there or a farmer's market, or we're putting a big screen up to draw people in. So all those things that you might have heard about with placemaking, we're really considering here as well. So that was a really quick whistle-stop tour of an example of an emerging trend in residential real estate.
I'll be handing over to Jessica Tomlinson from Savills. She's going to give us some market update on the housing market in the UK. Jessica, when you're ready.
Yeah, great. Thank you. And good afternoon, everyone. So yeah, as Maddie said, I'm Jessica Tomlinson. I'm based in the residential research team at Savills. So today I want to give you an update on the UK residential market. So there's obviously a lot to cover. So main things I'll be touching on are some recent house price movements, some of the impacts we've seen on the mortgage markets, namely due to the base rate increases, and then also run through the rental markets. So if we start by taking a quick look back at what we've seen across the housing markets over the last couple of years, but also over more recent months. So I'm sure all of you will be aware of the very well documented kind of period of remarkable growth and activity that the UK housing market experienced over much of the pandemic. And just to kind of reiterate that, so the average house price growth from June 2020 to September 2022 was on average of 26% across the UK. So that's according to the Nationwide. So just showing that period that we saw. But it really was the events of September. So the mini budget, it definitely caused a shift for the UK housing market. It marked somewhat of a turning point. We saw that initial turmoil in the mortgage markets directly following that mini budget. We saw quite a dramatic shift in some of the rates that were on offer. And that did result in some house price falls. So according to the Nationwide again, on average, falls around about 4.3% over that 6-month period from September 2022 through to March this year. Now, there was also a drop in mortgage approvals. So you can see mortgage approvals for purchase, according to the Bank of England, dipping to about circa 44,000 compared to that higher number that we had seen previously. But more recently, so if we take May, we had seen a bit more stability return to the mortgage markets. And as such, there was a bit more kind of behind, there was a bit more, I suppose, stability is the best way to put it. Mortgage approvals for purchase, again, according to the Bank of England, increased slightly, and house prices were actually relatively stable in May. So they were only down by a marginal 0.1%. And on the next slide, the market metrics really just show that progressive improvement that we saw in the markets, namely over the first 5 months of this year. So there's 4 charts on the screen, and they're all using data from 20CI, and they're a company who track what's happening across the property portal. So this is looking at whole market, some key market metrics, and they're comparing each month. So you can see May is in the orange bar in the key above to the same month between 2017 and 2019. So that more normal market, that kind of pre-pandemic norm. So if we start with agreed sales, so the first chart, we can see that those have definitely recovered over the period from September. And in May, the newly agreed sales were actually only 2% below their pre-pandemic norm. So moving on to the next chart, number of fall throughs, and that's a good indication of how confident people are in the market. So we've also seen that follow a similar trend, so declining month on month since October last year. And then finally, looking at that third chart, so the number of price changes, we've also seen those fall back over that same time period. Now, the final chart is looking at new instructions. This is obviously particularly important when we look forward, as it's the amount of stock that's coming to the market. This has followed a slightly different trend. So you can see new instructions have actually eased back slightly. They're around about 10% below that pre-pandemic norm for May. So that was the market up until May. But you will have seen a lot of the headlines. We've seen some more turbulence, kind of another bout of turbulence over the past few weeks. So this is the latest June data. It was out on Monday. So in terms of house price growth, this is looking at the Nationwide again. Actually, value prices were up marginally by 0.1%. So again, relatively steady in June, on average about 3.5% below where they were a year ago. Just given kind of what we had seen over the past year or so in terms of movements. Now, because the house price growth is obviously only kind of taking into account June as a whole, and we've only started to see that bout of turbulence over the kind of final 2 weeks, it is that we wouldn't expect to be seeing too much of an impact yet, but obviously those challenges in the mortgage markets might mean that we see future falls. But in terms of the market metrics, and these obviously will hopefully show a little bit of the impact of those of that turmoil. So looking at the first agreed sales, this did dip slightly in June, so around about 9% below that pre-pandemic level. And then the number of fall-throughs did increase slightly in June. And we're likely to see these measures kind of continue to reflect that turbulence of the last few weeks over the next month or so. So that's how the market is, but to put all of that recent movements and those rate changes kind of into context. So first looking at CPI inflation, it does look as though CPI inflation did peak back in the final quarter of last year, but it's core inflation that has actually continued to increase slightly, and it's keeping that overall inflation level slightly higher than expected, and at that higher level for slightly longer than expected. So as a result, we did see the MPC at their latest meeting back 2 weeks ago in June, that the bank base rate was increased for a 13th successive time, up to 5%. And the expectation kind of amongst the economic forecasters is that there may be further increases to that bank base rate in order to control levels of inflation. But what that has meant for mortgage rates, well, the chart is looking at, back one slide. Perfect, thank you. So the chart's actually looking at the nationwide average quoted rates for a 75% loan to value mortgage. And on the chart, we've got the bank base rate, 2-year tracker, 2-year fixed, and a 5-year fixed. So initially, if we look back to 2022, you can see that as the base rate started to increase, so did those mortgage rates. Up until that mini budget time, so in September, you can see that significant spike in terms of rates. They then began to ease back slightly, as I mentioned, some of that stability returning to the market. And in March and April, we actually saw the 5-year fix dip below the 2-year fixed and tracker rates. But if you look at the end of the chart in the circle, so in June, the most recent base rate increase has now seen a tick up in those mortgage rates again, and the 2-year fixed rate is now close to 6%, just given the outlook for further base rate increases, as I've said, from the economic forecasters. So in terms of outlook, and these are our forecasts on the next slide for house price growth, and we did these forecasts back in November. So when we initially forecast, it was following that turmoil from the mini budgets. The markets had settled down, as I said, slightly over the start of this year. So we were feeling that they were slightly pessimistic, but given the performance that we've seen over recent weeks, these do look much more realistic, just given that interest rates are higher and they're expected to be higher for longer and into 2024. But just to mention, as we've seen slightly stronger first half of this year, it might be that some of those falls could be pushed into next year, but at a similar order of scale. So we are forecasting house price falls across the UK mainstream market, but to have a positive net growth over the 5-year period. And now moving on to the rental markets. Next slide, if that's okay. Perfect, thank you. And looking at the chart to start with, so this is whole market data from the RICS, so the Royal Institute of Surveyors, looking at the net balance of opinion on, again, some key metrics, but this time across the rental markets. So in the lines, there's 2 measures. So you've got supply and demand in the pink and the purple. From around about mid-2020, we can see that big gap between supply and demand emerging. Very much remained the case over the course through to May 2023. So as such, we saw pressure on rents, given that imbalance between supply and demand. And you can see rental expectations, which are the bars on the chart, very much remaining in positive territory over the whole of that period. And this just helps to kind of back up those record levels of rental growth that we have seen across the UK over recent years. And in the year to June, rents have increased by an average of 10.4%, according to Zoopla. But it is important to note that this is down from a peak, just given those affordability constraints that have started to creep in to the rental markets. And if we turn our thoughts to landlords, and as I've touched on, those changes in the mortgage markets have definitely had an impact on their finances as well. So this is looking at a buy-to-let landlord, again on a 75% loan to value mortgage. So on the chart, we've got a few things. You can see repairs and management, mortgage interest, tax, net profit, net of tax profit, and then you've got the net of tax profit as a percentage of rent shown in the blue line, and that's the one that's really seen quite a significant change. So that's been running previously at around about 20 to 25% of gross net value coming out as cash profit after those landlords have paid tax. But it's the impact of those interest rate rises that we've discussed, also those restrictions on tax relief that have really only started to show up in this chart as rates have gone up. And you can see that that affordability has been eroded relatively quite quickly for those landlords, especially those who are using mortgage debt to fund that portfolio. And then finally, in terms of kind of an outlook for the rental market, so the imbalance between supply and demand is still remains significant. So we are expecting that continued imbalance to take some time to see any changes. So expecting that to continue. So those newly mortgaged buy-to-let activity, just given the kind of pressure on the mortgage markets that we've touched on, is likely to fall slightly further. And it's those smaller, more indebted landlords who may be impacted most significantly. So they'll look to either reduce their exposure, realign their portfolio, or possibly exit when applicable. And that's just likely to keep some further upward pressure on rents, so limiting that supply going forward. But those larger equity-rich landlords obviously will be less impacted by some of those mortgage changes, and they'll also be able to kind of spread some of those difficulties across a wider pool of tenants. So they could see this as somewhat of an opportunity. And that is everything from me. I think we'll take questions at the end, but thank you very much for listening.
There's a few questions, so what we can do is remind you of these, but just so that we keep to our time. If you join slido.com, #futures23 if you haven't already. You can keep adding to these questions as we're running through the presentation. So this is the first one, as Gafar points out. A lot of us on today living in London. If I just move, there's another question as well. So we'd like to know whether you currently rent, own or live with family. If you start to have a go on that one as well. You can do this at your own time, obviously, as we're going through all of this, but just to show what's going on behind the scenes. And there's another little question, if I just let you know about that one. So question about if you're currently renting. Have you had to move because of a rent increase? It's all anonymous, but very interesting. So please do participate in that. Another question here. Will you be considering home ownership in the near future? A few options on that one. I think there might be one more Savills question. Just have a quick look. Yeah. Do you see home ownership achievable? And then another one there, you might not want to rent a home, own a home. I think that's all the Savills questions. Yeah, in which case, I'll duck out a minute and hand back to my colleague Ian.
I would say my way of introduction, I'm Ian Fletcher. I'm a Director of Policy at BPF. The Federation has two Directors of Policy. My focus, I think I've got the better gig of the two. I'll let you judge, but I look after sort of built environment and then also the sort of alternative sectors. And my colleague Jon looks after our work on tax and commercial property. I've been doing this for a number of years. Probably what keeps me interested is it's just such a dynamic area of policy. Housing and planning policy always changing. Governments and oppositions wanting to do new things, talking about new things. And the sector itself has innovated significantly over the last decade. And extended itself into various types of living assets. Got about 10 slides, and I'm going to focus on firstly just a little bit about our work, a little bit of context. I'm going to talk about the issues that are on our plate at the moment. I can't cover all of those, so I've sort of plucked out about 4, and then a little bit about our engagement work with politicians, just to give you a flavour of what we do. And as regards our work, as we said at the start, we sort of structure a lot of our work around various committees of members, have huge participation across the sector on those. If you look back 10 years, we probably would have had just the 2 of those, the residential board and residential management committee, that looks at the sorts of nuts and bolts of managing residential property on a day-to-day basis. But we have evolved to reflect what our members are investing in. I sat on the Montague review, and so build to rent has always been sort of close to my heart from its inception. And then also student accommodation, healthcare. In the last couple of years, we've established affordable housing committee because a number of our members are now investing in all types of affordable housing. And we have many more working groups than I've covered there that look at sort of specific topics that are contemporary. Just the context, just two slides. Obviously, Jess has given us a huge richness and variety of data on the residential sector. I'd wanted to just pluck out that rents clearly are rising significantly. That's been taking place post-pandemic. Last couple of years was a little bit slower in London, but now London has sort of accelerated and has an average rent that is higher, just above the national average. And this slide looks at the relationship between average earnings and residential rents. Our members feedback to me that the reason that residential is attractive to them as an asset class is that it very much mirrors gross earnings, and therefore the things that they're paying out, the pensions that they're having to pay for, generally sort of grow with average earnings as well. But as you can see, there's been quite a disconnect between those 2 lines over the last 2 years, and that is probably unsustainable. Helpful at the moment in terms of landlords themselves facing significant inflationary pressures, but you can't have your customers paying a lot more than they're able to afford for a prolonged period of time. That, however, clearly creates sort of political pressures, and Renters Reform Bill reflects the fact that back in 2017, Jeremy Corbyn, I remember him, did surprisingly well and took a few seats off the Conservatives, reduced Theresa May's majority, and I suppose a penny dropped within the Conservative Party that they were not really bringing forward policies that appealed to the younger part of our population, and therefore out of that, renters reform sort of grew as an issue that the government wanted to pursue. The biggest change in renters reform is that at the moment you have a tenancy that generally will be sort of fixed. It can be 6 months, can be a year, and the landlord has the right to go and repossess that property at the end of the term without having to go to court. The changes that we're seeing will mean that landlords will have to go to court to be able to obtain their property, and tenants will have a greater security of tenure and indefinite tenancy that can only be brought to an end by grounds for possession. There are various other aspects to the renters reform, a new ombudsman, a register of all landlords. At the moment, there isn't that. And then things like strengthening rights for tenants to keep pets, trying to improve standards of private rented property, not necessarily part of the bill, but a separate piece of work government's doing on decent homes. And generally for institutional landlords, a lot of this is not threatening. Many of them are already members of Ombudsman. As we've heard, they are pet friendly, etc. But the changes to the possession process and to the sort of the important, most important parts of the tenancy agreement are significant. We have various priorities to try and ensure that we sort of won one battle, which was to ensure that purpose-built student accommodation is able to still issue fixed-term tenancies. It doesn't really make sense to have an indefinite tenancy in student halls. The key thing we're pushing on is to ensure that the government delivers on the reforms of the courts. Clearly, if landlords are going to have to go to court, then they want that process to be efficient. At the moment, it isn't. So articulating that to MPs as the bill goes through Parliament. I move on, and another, I suppose, issue that sort of emanates very much out of current conditions is rent controls. A number of mayors around the country, most prominently the Mayor for London, Sadiq Khan, has called to be given the powers to be able to control rents in London. Similarly, the mayors of Manchester and Liverpool. There's not a lot sometimes that economists agree on, but there's one thing that just about every economist agrees on, that rent controls have various very damaging effects. And therefore, we've been keen to articulate that. The current government is adamant it would never provide the power for mayors to introduce rent controls. But we've done a lot of engagement over the recent months with the Labour Party. We're really pleased to see in the last month or so that it came out and also affirmed its view on rent controls and didn't want to provide those powers either. I should have added that in Scotland, very different, and Scotland is on the road to rent controls at the moment. Another very topical issue is planning for housing. Planning is for housing changed about 5 years ago. What's called the standard methodology, which is the way that housing numbers are calculated in a local area and then find their way into local plans. About 5 years ago, the government made the decision that it would impose the numbers on local authorities based on what I've said, the standard methodology. There was a huge sort of rebellion of Conservative backbenchers a few months ago as the Levelling Up Bill was passing, and they wanted the government to step back from these imposed targets. And government had the numbers to actually win the vote. Labour would have voted with them to retain the top-down numbers, but for the sake of unity in the Conservative Party, they stepped back, and now those numbers are indicative, and local planning authorities have the ability to reduce those numbers. In the last few weeks, the Labour Party has come out and said that it would go back to the old system, and has coined this phrase, back the builders, not blockers. I think it's quite healthy actually to have the two political parties in a different place. I think that raises the profile of housing and the challenges that people face overall. But we have clear blue water in terms of the two political parties and their views on planning for housing. And then on engagement with politicians, we are clearly at an important part in the political cycle. There will be a general election in the next 18 months. That means for an organisation like BPF, we start to broaden our approach to our lobbying, reach out to the opposition parties and engage with them. We will have a heavy presence at the party conferences this year. Housing is one of the, and planning are probably two. There's a lot of issues that affect property that don't really sort of make it onto the political party manifestos. They are too niche for that. But the kinds of things that political parties tend to be interested in are housing planning, regeneration, affordable housing, business rates. So we will be articulating the industry's views on those. We've had recent meetings with Secretary of State and the Housing Minister. Got a meeting with the Housing Minister next week to talk about the government's infrastructure levy. But as I say, we're broadening our perspectives, very much engaged with Labour at the moment, trying to shape their views on housing and planning and other issues. And then in the House of Lords, that's a good place often to be able to affect change in legislation. And there are a number of Lords who are sort of specialists in the sort of housing area, people like Lord Lytton, Lord Best, very knowledgeable of housing issues, and people that we like to work with a lot. And you can just see me on the right-hand side in the picture with Lisa Nanna, sort of half of me chopped off there. But that was our round table with Lisa Nandy a few weeks ago.
I'm Jess Cunningham. I'm the Assistant Fund Manager here at, for our Build to Rent fund in Legal and General Investment Management in our Real Assets Department. And for this, I was asked kind of by Maddie and the team to kind of talk about the investor perspective and to look at, why is there a particular drive and an interest to invest in residential real estate? And alongside that, looking, as Maddie's alluded to, some of the challenges that and Ian has as well within the sector, and how those investors can kind of help potentially in sort of overcoming them. So if we move to the next slide. So this is kind of focusing on, I guess, build to rent. That's what I'm familiar with. It's what my day job is. But I think a lot of what I'm going to say is actually very applicable to a lot of the residential sectors. And Jessica before me has talked already very much about some of the stats for residential, the sort of supply and demand imbalance. These are just some snapshots from our sort of own internal sort of view, just showing that supply and demand imbalance, and showing that we've consistently not met targets in terms of the supply for housing units. Rental demand has increased and home ownership has decreased. So we are continuing to see more rental demand, and we're also seeing a higher proportion of renters within all age groups. So and that's something that we actually see in our build to rent assets, that actually our demographics, while the majority is, as you would expect, in the sort of young sort of professionals market, we actually have a lot of families that rent with us, and a lot of sort of the older generations as well. So a lot of supply and demand and issues, and what does that mean, and what does that signal as an opportunity? Sorry, if we could keep on that slide just for a second. So that just signals an opportunity for third-party capital to kind of come into residential and start to address this gap. The strong sort of demand also, as we've already seen, leads to rental growth, which for a returns perspective from investors is attractive. And I think the other thing to say is that because we've got these long sort of standing trends of a lack of supply and high demand, that kind of leads to a stable and consistent cash flow. So not only is it the rental growth that's attractive, but it's actually having that stability in the cash flow that is really important. And actually something to flag for the residential sector in particular is that for build to rent during the sort of COVID pandemic, and all of the issues that were going on along the commercial real estate side of our rent collections, actually for residential, the rent collection that we received as a fund was really, really strong and near enough what it would be in normal circumstances. So it really sort of, I guess, lived up to the research sort of narrative that residential delivers you strong, stable cash flows. If we move to the next slide. So this is looking at, I guess, the sort of yield aspect of the residential sector and build to rent, and its sort of counter-cyclical nature. Again, we've sort of living live examples at the moment in terms of the recent sort of market economic volatility. But actually residential has historically always demonstrated very low volatility in its yields, you'll see there, in comparison to other sort of commercial real estate sectors, where there's a much wider range in terms of the yield comparison, residential always stays within quite a narrow range. So it means that from an investor perspective, if they have a real estate focus, or they're looking to diversify their portfolio, residential is very attractive because it is counter-cyclical. And again, what we've seen there on the right hand side chart is what the BTR sector sort of only moved out by sort of circa 30 bips in terms of its yield, compared to the commercial sector of sort of 90 bips. So again, stable deliverable returns, which is attractive for investors. If we move, yeah, perfect, thank you. And this slide was really just to show the opportunity, particularly for the UK, and particularly for institutional investment into the residential sector. So at the moment, we think that institutional investment only makes up a total of 1% of the housing market and 3% of the rental sector. And actually, when we compare that to some of the other countries throughout the world, you'll see a list there on the left-hand side. We are a significant minority in compared to other countries, and actually, therefore, there should be, if we look to other lessons learned from those countries, but there's an opportunity there to very much institutionalize what we do in terms of our residential sector. And it's also worth flagging in terms of, as Maddie alluded to earlier in the case study, actually in terms of what build to rent is, it is about one owner owning the whole block and delivering the whole block, managing it, as opposed to, I guess, more of the traditional sort of buy-to-let landlords, where they might have lots of individual units or individual homes. So as the sort of slide here is showing, there's actually quite a highly fragmented nature to the residential market. So kind of, I guess, summarizing in, I'm hoping 3 kind of key reasons why investors like the sector. It's that stable occupational demand that drives sort of strong, stable cash flows and income for investors. It's counter-cyclical, providing, again, strong returns and stable returns for investors. And there's an opportunity here to get into the sector that should be able to deliver some more institutional ownership of rental units. So if we move on to the challenges, and we've talked about them in the various different sections before, but I thought I might just address in terms of how investors can help potentially. So the first is looking at that supply and demand imbalance. Well, we've already alluded to the fact that obviously the government sort of scrapped its housing targets, that they haven't so far been meeting demand anyway. So actually, in terms of how we are going to be getting more supply into the market, it's really through that third party capital and investors coming in, and those private investors coming in to be able to develop and build more units. And I would say that actually this sort of, we've seen the stats for, say, build to rent, but also this is across all of the living sectors. So actually the supply and demand imbalance is across all housing units, and therefore actually what new capital and actually new ideas from sort of other countries can bring in a more diversified range of residential products. So we've seen kind of the introduction of co-living in the UK, but we've also seen, from a senior living perspective, looking at retirement villages, and also alongside that, looking at affordable housing, which I'll move on to shortly. So there's an opportunity there for the capital to come in to develop more units and to start to try and address some of that gap that we've seen before. If we move on to kind of rental affordability, sorry, staying on this slide till the end, but rental affordability, and I'm going to link it in obviously with affordable housing. And again, we've seen those stats in terms of the rental growth. Everyone's very probably aware of where rent increases are going. And I would say that actually that concern, oh, sorry, the light's going in here. The concern is that, rents will increase to a point that makes them unaffordable. And I would stress that I think from an institutional investor perspective, as I said, it's all about the long-term stable cash flow. So it's actually about realizing a sort of achievable and sustainable rental growth, not necessarily kind of having a situation that means that the product becomes incredibly unaffordable. And I think that actually investors are looking more and more into affordable housing, and again sort of leading into the diversified product piece in terms of the supply and demand imbalance. Affordable housing, investors are looking at it on the basis of both the affordable rent side and the shared ownership. So again, trying to have an opportunity for a diversified offering to people in terms of where they are for what their needs are in terms of renting versus, say, something like shared ownership. So there's a lot more interest in that sector. The other real attraction for affordable housing, though, for investors is the ESG aspect. And I think it's we can't underestimate how important this is for investors at the moment. As the Build to Rent Fund, we are regularly getting questions from our investors about our ESG credentials, about data, and actually for affordable housing, it's something that actually, as a social impact investment, is actually very measurable and important, and actually realistic. It's not sort of the greenwashing that you might see obviously in the press and the risk there. So from an investor perspective, affordable housing kind of ticks that social impact side very well. So that makes it very, very attractive. So ESG and I guess the issues generally that we do need to, as a global world, need to sort of decarbonize, get to net zero. And I guess what investors and institutional investors can do is put that investment in, whether it's through the sort of development of new stock phase and making sure that the buildings that they're developing are going to be net zero carbon in operation, or whether it's through looking at what do we have in our existing stock and actually are there ways of refurbishing those and being able to put in the sort of initiatives that, say, the smaller landlords who are a bit more capital constrained are just not able to do. And that also leads on to the fire sort of building safety aspect, which we've seen a lot, obviously, after Grenfell. We've also seen a lot of press recently about general maintenance in buildings and kind of mold issues and everything else. And all of this can be helped by institutionalizing the sector, because there is, again, that one owner that is responsible for the whole building. We have, our management companies that manage the building that make sure that the assets are maintained, and can make sure that, we have the checks in our units that, no one is living in a place that is unsafe. Moving on to the sort of regulatory reform and planning, and conscious of time, so I'll sort of probably pull these together quite quickly, but as Ian's alluded to, actually from an institutional perspective, a lot of what's already coming through in terms of the Renters Reform Bill we were already doing, and actually because we are long-term holders with no sort of intention to sort of sell off individual units, that security of tenure that can be provided to tenants was already there alongside the pet side and everything else. I think that in terms of the rent controls, that does can cause a sort of concern for investors, primarily where it's introduced where there's sort of no consultation. And that's why we work really regularly with the BPF, because, where rent controls have been introduced and without consultation, it's had a sort of negative impact in terms of investment maybe into that location, such as in Scotland. So we have within our own kind of residential agreements caps on our rent reviews ourselves that we sort of self-regulate. And so if there was ever a situation where, albeit that we've heard recent press that Labour wouldn't introduce rent controls, I think it's the consultation piece and working with the BPF alongside on the planning side that is really important for investors, so that they can make sure that they can have their voice heard, and also to make them aware of sort of policymakers aware of the fact these are long-term investors that are here to sort of stay. So that was a very quick run through. Sorry, I've very much taken us up to the wire, Maddie. Apologies.
I want to say a quick thank you to all our guest speakers. Thank you all. We do have a few questions in the Q&A box. We'll try to whiz through them really quickly. If you guys do have any further questions, please quickly pop them in the chat. The first one, I think, is for Maddie, but anyone's open to answer it in terms of BTR. It reads, BTR is ultimately a for-profit venture. Could you shed some light on how the profits are roughly spread across the scheme, maintenance, further investment, shareholders?
It's a fair recognition that it is a for-profit venture. In terms of the build to rent side, it is, we're developing new assets, so the majority of profits do go to our investors ultimately, who are predominantly pension funds. So the profits majority go there, but we do have within our operating budgets for individual assets an allowance for maintenance in particular, and also an allowance for sort of long-term capex to make sure that, and for the interests of the fund, we want to make sure that our buildings, as I've said, for the reasons of safety, but also for the reasons of, you know, depreciating value, that they are invested in.
Another question goes to Ian. Will you be raising the issue with high-rise flats still caught up in the cladding crisis in those party conferences? As whilst government funding was agreed, many of landlords still haven't lifted a finger towards getting it fixed, leaving thousands still stuck in unsuitable accommodation.
Yeah, it's a good question, and yeah, it takes up a lot of our work. It plays out slightly differently in our sector to, we're not representative of the home builders, and in the rental sector, our institutional rental accommodation doesn't have access to the building safety funds. It has different pressures on it. Clearly with student accommodation or build to rent, people will walk with their feet if they're not happy that their building is safe, and therefore there is a huge incentive to get on with it, and that's paid for by the owners of those buildings. The highlight that you see in the sort of press of this issue is mainly around owner-occupied accommodation, where there is a significant disconnect between the freeholder owns the land, the leaseholders, and the original developer of the building. And government has put in place, obviously, the building safety funds and things like the contract between developers and itself to try and remedy that. But it's taken its time, government, in terms of putting that all in place because of the complexities of the issues around that disjointed ownership.
We've just had one more coming as well. When you're building at such scale, 1,000 plus units, how do you ensure that required infrastructure in terms of school places, doctors, etc., can meet new demand?
So yeah, it's a really important question. So I guess it comes down to some of the agreements in terms of the planning process, and when we are building. So for example, at a Wandsworth scheme, there was within our section 106 an agreement in terms of a contribution towards the station. So it absolutely becomes part of the focus when it is the planning agreement goes in. We've also got a number of commercial units that sit on the ground floor of our development. So it's also thinking about how we can use those units that are to the benefit of the community, as Maddie outlined before, and actually what are the real needs. So is it something like a nursery? Is it something like a GP or a dentist? What is bringing 2,000 potentially additional residents to that area going to actually need? So yeah, it's very much a consideration when we're looking at those big developments.
Yeah, and just to add to that, we coin that term placemaking, and that's essentially what allows the infrastructure to be put in place. I think that is it. So I will hand back over to Maddie.
Thanks, Gafar. Good timing for my internet to start working again, so I can wrap up and say goodbye. I've missed that last 5 minutes, so hopefully there was a bit of Q&A there. But we just wanted to say there's so much more that we could talk about in this area. We haven't really touched on affordable housing. We haven't touched on co-living. We haven't touched on sustainability in that much detail, community housing. So there's so much more to cover. So we're really conscious of that. We kind of just touched on one area of the residential sector. I wanted to just say thank you very much for your engagement on Slido. We're going to see what we can do with the responses, and I'm just looking there, some really interesting things coming through in that in terms of getting involved with influencing policy and knowing how to do that and not. So we will get back to you on that one. In terms of engagement with BPF in the future, There's a bit of a hiatus over August. We've been really busy in the first half of the year, a little bit of a break, and then we'll be back with quite a few more events in September and onwards. If you have applied for mentoring, the matches will be announced in the next few weeks, so do keep a lookout for that. But I think that's everything. Thank you very much for joining us. I found it really interesting from all the speakers. So thank you to all our speakers for joining too. And we hope to see you at a BPF Futures or BPF event in the future. So thank you very much.